keeper. It's cheaper to keep her.
I trust that the assiduous viewer of this series will note that I have eschewed the reading of PowerPoints word for word, partly because this is not a third grade reading class, and the benefits of looking at graphs and equations are more poignant. But be that as it may, I've recognized there are different kinds of learning, and also in this summary of specific investment advice that maybe that is also appropriate. Starting with cash management, of course, use debit cards to obtain cash, credit cards for purchases. For the debit cards, the optimal amount is often far larger than what most people do. I've given an equation down there called the EOQ, and you probably want to make sure you have a debit card, maybe from a broker, maybe from a credit union, where they rebate the amount regardless of where you do it. For credit cards, get a no annual fee. If you figure it out, it's not worth it usually. People love those frequent flyer miles, worth maybe a penny and a half. By the way, that's generally not a good idea. You want cash back because cash doesn't expire and you have no minimums. And besides, many credit cards are out there available giving far higher returns or rebates. You know, when buying a car, new or used, and more often new, you may be offered a cash rebate or a 0% financing. You know, if you look at the present value, it's a wash. And frankly, it just depends whichever is appropriate given your situation. When buying a home, yes, you can. The interest payments are tax deductible, rent payments are not. And for a high bracket state, say like California, where you're in approximately the 1/3 tax bracket, turns out if you're paying $2,000 in rent, you can make $3,000 payments per month, and it turns out the cash flow is the same if you adjust your tax withholding with your employer. Use insurance sparingly, getting high deductibles. You know, if it's advertised, it's probably not good for you. That means you probably want term life. Do get medical for the kids, but not life insurance. Do start out early to max out your retirement pension plans. You have the one at work, and you also have something called IRA accounts. Not redundant, it's individual retirement arrangement accounts. When you max these out starting at the age of 20 instead of 30, going to 60, you'll double the amount at the end. Use no-load, low-expense ratio mutual funds. You may double it again. Notwithstanding some of the self-appointed gurus, the difference between the non-taxable Roth IRA and the traditional taxable IRA, the difference is a wash if you're in the same state of having income taxed at the end. The benefit to the Roth is that that tax is likely to go up at the end. One benefit to the Roth regardless is you do set aside more funds. You do lose the special capital gains treatment and qualified U.S. dividends special treatment for a lower tax rate, but turns out generally those are still better offset if you do use a deferred pension plan. You really only need to look at your account maybe once a year while doing your taxes. Who better do that to you? And there's the same stack of papers. And you may want to consider something called covered call option writing. And in all cases, they are better executed if you use wide limit trades. While stocks and ETFs, exchange-traded funds, mutual funds trading as stocks, often trade in a spread bid-ask difference of a couple of pennies, options may have quite a wide spread. So you might think of it as dipping your toe in the water. So you want to start high and lower it down if selling them, and they're in pennies or maybe nickels depending on the size of the option. In selling out of the money priced above call options, selling the stock if it happens to go up, disciplining you, it turns out that maybe the best thing to do is maybe go out a year or two. Now again, withstanding those self-appointed gurus of whom I could think of four, of which almost all of them are about wrong half of the time, do take your Social Security age of 66. Yes, it does increase, but if you look at present values, turns out anything above 5%, you're better off taking at the age of 66. Likewise, you may have to confront something called the required minimum distribution. You have to take it on your traditional IRA account, taxable, and on any pension plans associated with employers where you're no longer working. You're still working, you don't have to do it. By the way, it's suspended for the year 2020 because of the Big C. Starts out with you having to take out 1/27th of the amount of the previous year's balance, and that amount increases as you get older. Well, I trust that A, you didn't have to suffer for me reading it to you word for word. Don't get me started. And B, that I gave you specificity instead of those aphorisms of generalities such as work hard, study. Instead, I gave you numbers, specific things to do with Dr. C Invests.